We're joined now by Diana Layfield, CEO for Africa at Standard Chartered, to discuss the future of banking as she sees it on the continent. Thanks so much, Diana, for joining us this afternoon. Well, as the new regional CEO for Africa, you're responsible for the bank's operations in Africa. I mean, you've had quite a few months with this perspective, but you're no stranger to Africa's banking landscape either. What's your assessment of the banking environment in Africa right now with the presence that you've got in 15 countries?
We see Africa as a hugely exciting growth prospect from the banking sector, and that goes in line with Africa's own economic growth. As you know, we've seen much more exciting, balanced growth across the continent in the last 10 years. And typically the banking sector will both fuel and follow that. We think the next 10 years is going to be even more exciting for Africa, with broader balance, more sustainable growth in the continent.
I've come across articles where you've been quoted saying that you're ruling out competing in the local South African retail banking sector because you see that as a market that's well served at this stage, but 90% of your earnings do come through from emerging markets. So how does Africa fit into your strategy? What's your approach?
I think Africa for a long time has been core to our group strategy. As you know, we say we're focused on leading the way in Asia, Africa and the Middle East. So for many years now, our focus has been on those three continents. I think if you look at our presence in Africa, of those 15 markets, the majority of them we've been in for comfortably over 50 years and many for over 100 years. So this isn't a new commitment to us. This is a very long-standing commitment to the continent. I think what's changed is just our perception of its relative potential compared with the rest of the world. I think Africa's starting to sow, as we said, very, very new and exciting growth sectors.
I ask because we're interested in the kind of change in strategy you're adopting, if at all, because there was a point where, for example, big international banks had turned their noses up at the lower unbanked population on the continent, viewing them as high risk, until the likes of an equity bank in Kenya showed the kind of potential that market actually boasted. So what kind of change in strategy have you seen?
Well, I suppose I'd say I don't think international banks exactly turned up their noses at that market. I think it's just that different players have different strengths. So our strengths, given our lack of rural branch footprint, are unlikely to be in the mass market space. But I think what they are likely to be is in the broader consumer banking space, including a very wide range of products in the retail market, but also in the corporate banking space, where we're able to link African corporates, which are increasingly exporting to and importing from Asia and the Middle East and the rest of our footprint. So for us, the growth in trade with those regions is hugely exciting. Absolutely. And I think we're very well placed to be able to. So
lots of opportunity in future trade and investment flows as well. Having said that, we've got to take cognizance of the risk, and we've seen the G20 really leading the drive for change in the banking sector with regards to regulation, and that around the globe. What's your view on the changes being proposed on that, and what kind of impact do you see it having on banking on the continent and access to capital?
Well, I think the first thing to say is we're broadly supportive of the changes that are proposed internationally under Basel III. I think the great advantage for Africa is Africa's actually in many cases had a more conservative and more resilient approach to regulation even prior to the financial crisis. You'll see that most regulators on this continent demanded higher levels of capital and more protection around liquidity even prior to the crisis. And it's one of the many reasons that this country, amongst others, fared relatively well during the banking crisis. So I think our perception is that the majority of new regulation is sensible. We need to be very thoughtful about how that's deployed internationally, trying to get some sort of consistency, but I think Africa is pretty well placed in that context.
When it comes to your growth, are you looking at organic growth, or is acquisitive growth part of your strategy as well? Because there was a lot of speculation, given your the health of your balance sheet, around big ticket acquisitions. We even had Nedbank at one time being speculated as a target.
Our approach group-wide is pretty consistent, which is, generally speaking, we prefer organic growth. We think we deliver better value for shareholders when we can do that through organic investment. But clearly there are cases and times when either you can do something much faster or differently through acquisition. So we haven't ruled out acquisitions on the continent, but we have no immediate plans, and I think the challenge is in finding the right assets at the right price.